Jeff, what do you make of the futures just kind of making a move to the downside in the last 20 minutes or so?
Well, it seems pretty muted, but remember, Frank, if you look at the S&P futures right now, up 1 point. This is off of a week. Last week, the S&P 500 was up 5.5%. We saw a parabolic move in the NASDAQ 100 up about 7.5%. So if we go back to April 7th, the lows we put in after the trade tariffs, you've seen the S&P 500 bounce 17.5%. That's amazing. And I think it's been really perplexing to a lot of people who are either selling the bottom, who are underinvested. But right here, right now, I think this is quite healthy to see the market try and find his leg to see if it can take another leg higher.
All right. Jeff, your word of the day is poised. Why, though? Who's poised right now? It seems like a lot of people are getting upset and panicking, specifically when we're talking about bond investors and people looking at the potential deficit increasing spending bill that just passed the House.
I would say the market is poised, Frank. There is certainly a lot of noise and a lot of indigestion out there, but what seems is the market is poised, and that's why is my WEX word of the day. It's poised to test the new and make a new all-time high. So I think we're only about 4.5% away from that all-time high we put in earlier this year. And when the market seems like this, it's almost like trying to take a basketball, keep it underwater. It doesn't have that ability. So I think we retest new all-time highs in the short-term future.
All right, so again, the bond yield spike after that Moody's downgrade of the U.S. credit rating. But the last few days, we've really seen muted moves. I think yesterday, the S&P was down like 0.1 or 0.2. It was a very slight move to the downside. Mike Wilson from Morgan Stanley, he was on our air yesterday talking about his thesis when it comes to this muted move in the market. I want to hear from him and get your take.
Well, our math tells us that retail is buying about $5 billion a day, okay? CTAs and systematic strategies are buying about $5 billion a day, and corporates are now buying because earnings season is over. That's just a lot of money. And so, like, where's the, like this? If you get any selling, it just gets stopped up in the near term.
So, Jeff, I want to get your take. He also added that if the market declines by about 5%, that dynamic could change.
Yeah, I think he highlights the fact that there was a wild bifurcation in the month of April. Typically, you see retail selling in that type of distress and institutional buyers stepping in. It was just quite the opposite. You saw institutions having to deleverage, and that goes back, Frank, to the fact that we saw such an over-concentration in those Mag 7, those top 7 names of the S&P 500. So it is an interesting time, and that's why I think the market has the ability to go higher. But in relation to the bond market, you know I cut my teeth in the bond market. I traded U.S. Treasury futures for over a decade in Chicago. And I think that move we saw on Wednesday, it was actually more muted. There was more noise and reaction due to the fact that we saw only about a 10 basis point range in the 10-year. And the 10-year right now is right back down to 4.50%. But I think we saw more profit taking, Frank. That's why we saw that acute move lower in the Dow as well as the S&P 500, because we had such a bounce off of April 7th. So I think there's more in play of profit taking versus people freaking out and panicking about the 10-year note at 4.5%.
Are bonds attractive right now? And if so, what end of the curve would you look at if you were looking to buy some bonds?
Well, I think Warren Buffett would say absolutely the bond market is attractive. He has $348 billion sitting in short-term treasury bills. So I think you're going to see that dynamic. But the one thing that's not talked about enough, being a former bond trader, is that we are seeing about $8 trillion maturing this year for the federal government in 2025. Give or take $1 trillion, Frank. That maturity is allowing bond traders to say, I want a higher coupon. I want more juice. Give me more interest if I'm going to be participating in demanding these bonds. And that in itself is why I think the 10-year note is higher. We're actually seeing cooler inflationary data, but there is a lot of confusion and perplexity about what these tariffs potentially could bring down in Q3.
Give or take $1 trillion. You don't hear that very often.
No, you don't.
Jeff, I want to get to your pick for today. What's your pick and why?
Visa. This is the behemoth. This is an essential name. If you look at the market cap, it's almost $700 billion. The closest is MasterCard, obviously about $500 billion. You look at American Express, way down at $200 billion. In this name, it's only about 3% away from its all-time high, Frank, but I think it has momentum. I think you're seeing the consumer spending. They continue to expand in other countries. They're in about 200 countries right now. With a forward PE of 31, I'm not saying it's cheap, Frank. You look at MasterCard with a forward PE of about 36. I'm just saying there's a momentum in this name. And when you see this type of distress and volatility, look at the VIX, still at 20. When you see this type of volatility, people go up in quality. People want to own these essential names, as I own in my Essential 40 ETF, Frank. So going into a quality name like Visa is going to give you an opportunity. If you do see these interest rates go higher, people are going to sell what they don't know, and they're going to buy what they need.